All right, welcome to another episode of the Multifamily Masterclass with Neighborhood Ventures. I'm Jamison Manwaring, CEO of Neighborhood Ventures, and I have Bart Dill, our Director of Investor Relations,
What's up,
with
guys?
us too. So we have a great discussion today. The multifamily market, there's always good stuff happening and interesting things happening. And when interest rates are moving like they have been moving, there's always something going on. Things are changing. So you have to stay on top of it. There's always the fundamentals that drive the industry, and then there's things that move and change the industry from time to time that can be big impacts. So we're going to dive into a few of those things today. And the first thing I want to start off with is a report from ABI Multifamily, who we work with a lot here in Phoenix. They're a apartment broker, and they really specialize in multifamily here. And they have a report for the June sales during the month in Phoenix, the Phoenix metro area. And this is really interesting to look at and good data to consider because these sales, they're way down. Last month, there were a total of 5 transactions in the 100 plus units. So these are the bigger apartment buildings. Then there were 6 transactions in the 10 to 99 units, the smaller mid-size. So a total of 11 transactions in the month. That's way down. That's like 10% of what it was in a month in the past few years if we looked at those month reports. But still good data, and it's important to look at comps, comparable sales, see what those trends are doing. And as expected, the 100 plus units tend to be more stable when it comes to price because these big apartment buildings are owned by typically big institutions, people that have deeper pockets. There's not much distress in this market. Pretty rare where a big institution in multifamily would have a hard time selling a building and be any sort of distress. And there has been some distress in real estate, in commercial real estate recently, but not in multifamily. And so when you look at commercial real estate, you really have to splice it out and say which asset class within commercial real estate are we talking about? Are we talking about office? Are we talking about retail? Are we talking about multifamily? Are we talking about storage? Are we talking about industrial? They're all very different. Multifamily is still a highly desirable asset. I would still say probably the number one, if not number two. Maybe industrial is more desired today, but multifamily, people want to own it. So these large groups who own big apartment buildings, they do not want to get rid of these buildings. They want to hold on to them. And last month in June, there were 5 sales of apartment units over 100 units. Total sales volume, $590 million. And we'll just look at a couple of these. The first one is the Blake. This is North Phoenix on Tatum in Tatum Boulevard in North Phoenix. 400 units. Total price $183 million. So
It's cheap.
we're talking if people are wondering if there's any money flowing into multifamily, it's flowing. I mean, smart people know that you want to own housing right now. Housing is a good place to be, especially when the cost of housing and the cost of building has moved up so much. So the Blake sold for $183 million. That is $457,000 per unit. So, I mean, in most markets, if you pay $450,000 for a house, that's not abnormal to say I'm going to buy a house for $450,000, but that's a 4-bedroom, 3-bath house. So this property sold for $457,000 per unit, brand new, built 2024. And really validates that smart money, people who can raise $200 million for one asset, they're buying assets and housing in Phoenix. The next one is the Carter, very similar This is in North Scottsdale, highly desirable area. Scottsdale's, the area that Bart would hang out before he got engaged. That's cool. It's where the cool kids are.
I actually know people that live at the Carter.
Oh, yeah. Yeah, I'm not surprised. You would. During the pandemic, Scottsdale was ranked like the #1 city to live in. And I actually lived there during the pandemic and agreed it's a great place to be. 365 units, 161 million, 442,000 per unit. So again, that's a 4-bedroom house in most markets.
Yeah.
For the Carter. Now looking at a few different types of assets, but this is still a big one. Tides on Country Club. So not built in 1986. 118 million for the 582 units. I mean, this is a big purchase, over 200,000 a unit. And then last one we'll look at and talk about specifically, this one in Deer Valley, 27th Avenue, and this is near the TSMC plant in that general vicinity. 264,000 a unit. Now, we're not going to get into detail on each of these, but each of these have different unit mixes, meaning some apartments have 2-bedroom, 3-bedroom, 1-bathroom, 2-bathroom. When you're paying more per unit like the Carter and the Blake, these are probably larger unit mixes. They're not studio apartments.
Yeah, maybe some more amenities.
Yeah,
Yep.
Deeper amenities, newer build. And then there's also a couple comps here. This one on South 7th Avenue, not a up and coming area, 116,000 a unit. And then the last one we'll point out, there's a sale in Tempe on Orange Street, 325 a unit. And then Urban Falls, 314 a unit. That's on 40th Street, nice area in East Phoenix. So transactions are happening. I'll just say the biggest change between now and 2 or 3 years ago when the apartment market was really hot is one thing, and that's debt. You could get debt for 3%, 3.5% 3 years ago, and that makes everything look better, especially if you're going to take leverage of 50 or 60% on a purchase like this. Some of these are cash transactions, so they don't care. They're just coming and buying in cash. They're saying, we like the cash flow from this. We like what's going to happen with rent growth. We like all the tax advantages to investing in real estate. But it's good to see these transactions happening. They're way lower than they were when rates were 3, and that was kind of crazy town. But even when rates were kind of normalized, the number of transactions is way down from what it was before. Okay, stuff is happening in the multifamily space. There was a big announcement. WaFd, who's a bank that we actually have a relationship with, they sold approximately 2,000 multifamily real estate loans to Bank of America.
Wow.
In a $3 billion sell, $2.9 billion sell. I heard the CEO of WaFd on CNBC, and he said this move was to shore up their balance sheet. Banks are constantly doing this. They're moving some loans off to bring some cash in. But he said the sale of these assets and these loans were these were high quality loans. And it puts banks in a position, he said, for them, they may end up lending this money out again now that they have some additional cash. But definitely a big move. We also saw New York Community Bank offloaded $5 million in their loans to J.P. Morgan Chase.
And it talks a little bit here is a big reason is they want to mitigate their exposure to the multifamily asset class because of the rising interest rates that we've seen since 2020.
Yep. And it's important for them to kind of rebalance their books.
Yeah.
The other important thing to look at is these two lenders are some of the most active lenders for multifamily. So they did a lot of loans, and they had a buyer on the other side of this transaction, J.P. Morgan Chase in one case, and Bank of America on the other case. Banks with deep pockets coming in saying, let us look at this, let's see this portfolio, and see if we want to execute and buy this. I actually believe the WaFd sell ended up selling to PIMCO, but who's even probably more in-depth and sophisticated than Bank of America. But these buyers, they looked at this. They said, we're going to go ahead and buy this debt. So when things like this happen, it just identifies an evolving landscape when it comes to lending. And we talk about that a lot on this podcast, how it's hard to get a loan right now with commercial real estate. It's not because the underlying asset is not performing well. It's because the banks are trying to get their crap together. And this all started off when Silicon Valley Bank, Signature Bank had all their problems with financing.
Yeah.
This has a real impact on operators. And what we're seeing as we are right now, we're buyers. We're looking for opportunities to go buy assets at a good value because this freeze in lending is impacting apartment owners. And if apartment owners are not well capitalized, or they've run out of money, or they can't get a refinance on their short-term loan, then they have to unload it at a discount. And it actually provides a great opportunity if you're ready for it.
No, I think it's the perfect time to go capitalize on distress, and that's a huge reason why we launched our fund. And here it talks about if you're going to capitalize on distress, make sure you're focusing on emerging markets. And, Phoenix is a big city, but all these different areas in Phoenix are considered emerging markets. Having our brokerage team here is a huge help to us because we can identify some of the best places to go purchase. And I know we're being really conservative with our next acquisitions for the fund.
Yeah, and we're going to talk a bit more about that later in the podcast. But you have to really look at some of the underlying things that are kind of below the surface, and this is certainly one of them. This article came out in Forbes, and we've been seeing this for a while, but this will continue for the next year to 18 months as interest rates stay higher for longer. There is going to be some distress, some opportunities to go buy these assets that otherwise are really good assets that can be purchased at a discount. One of the thought leaders in the multifamily industry is Jay Parsons, who is an economist. He writes a lot of articles and is one of the preeminent macro level and micro level economists when it comes to multifamily. And I'm just going to read a couple of things from a recent post that he had that I think are really important. He said, first off, U.S. apartments added 257,000 net new renters in the first half of 2024, the second strongest first half for a calendar year in over 20 years. It's yet another reminder that for all of the challenges facing multifamily operators this year, demand ain't one of them. So he talks about what's driving this demand, and he has 4 drivers that's behind this strong apartment demand. And just kind of put into context, he's talking about over 250,000 new renters that are coming into the market, and that's nationally, so that's a big number. But we see all of these apartment buildings that have been constructed, and we're wondering, are they getting filled up? This is part of the reason why that they are. And what's driving the demand? The first one is that renter household formation is rebounding again after softer numbers last year. So when you think of renter household formation, this means people moving out of their parents' basement. Mm-hmm. This means buddies who've been sharing a place and a bachelor pad since college are deciding to grow up a little bit and get their own studio. It means couples coupling up, moving into their own place.
I think it's also people downsizing too, going from a home, boomers, and wanting to rent now.
Yeah, absolutely. Yeah. And the household formation numbers, that's always a growing number in a market like the U.S., but that has rebounded after softer numbers last year.
Correct. So with 257,000 new renters in the first half of this year, the only other time we've seen that amount is in 2021. And we've had back-to-back years of record supply in the market. Jamison, is this scenario where supply is in fact creating more demand? Would you agree?
Yeah, that's kind of part of his argument, is that with new apartments that are coming online, people are saying, hey, now's a good time to go rent.
Yeah.
Because there is a lot of supply out there. It's kind of like if, iPhones all of a sudden, there wasn't a line to get an iPhone. We saw that there was a lot of value in converting to the new iPhone. In the case of an apartment, maybe I can move into a newly remodeled apartment or a brand new apartment.
Yeah.
It's like, hey, let's go ahead and make that jump. That's the second part, is that supply is creating some of this demand. So the third point that Jay has is that affordability for apartments is actually driving that demand as well. So some people are saying that rent is high, that we need to figure out how to bring rent down, and they're actually not looking at the real data. The real data shows that renting is far more affordable than buying in almost every metro across the U.S. In many of the metros, it's double the cost to buy versus rent. And that wage growth has actually outpaced rent growth for about a year and a half now. So wages have continued to grow. Rent growth has not followed. Rents have been pretty flat over the last 18 months. So this affordability opportunity is also increasing the demand.
Yeah, I think people are, relatively smart too with their money. If you're looking at what your mortgage payment's going to be if you were to go buy a home versus what your rent payment is now, it's probably a good time to continue to rent, at least until rents go up and it's a little bit more level with a mortgage payment. Then it makes more sense to potentially make the transition.
And the fourth reason why he says the demand for apartments is still so strong is that there are fewer move-outs who are going to purchase homes. And intuitively, I think we understand this because we see how expensive homes are. But typically, you will have people who decide to rent for a short amount of time, then they want to move out, go buy a home, and we're not seeing that as much in this cycle. We're seeing people decide to rent for longer, and that is driving the demand for all these new apartment units that have been constructed. And that's why occupancy continues to be strong. The fourth one being fewer people are moving out to go buy a home.
Yeah, I have some friends who were renting in Class B apartments that they probably had the capital to go purchase a home, but instead of going and purchasing a home, they decide they're going to go find a Class A apartment that has a workspace, that has a gym, and just go put their money there and live there.
And I want to point out this graph that you see here. If you're just listening to us, you won't see this, but if you're watching us, you can see this graph. And this is that apartment demand is robust so far in 2024, and it talks about the net absorption, and that is the move-ins minus the move-outs for apartments in the U.S. And if you look historically, you can see that in 2022, there was a net decrease by almost 200,000, 150,000 people moving out. But as we look at the first half of this year, this is one of the strongest years we've had in 15 years for net absorption, more people moving in, and that's the blue part of this graph. 2021 was strong, but besides that, if you look over the last 13 years here, 2024 was one of our strongest, if not the strongest, net absorption, which is a good thing if you are an apartment owner, apartment investor. You want to see strong net absorption. The first half of 2024 came in very strong. Okay, so the New York Times came out with an article that said that multifamily might be in trouble. And, New York Times is a big media outlet. It's important to dig into this. And for this, I'm going to also turn to our friend Jay Parsons, who's one of the preeminent leaders in the data behind multifamily. And he brings up this question. He says, is this actually true? Is what the New York Times saying that actually true? And he says, well, even though there's some challenges for apartment owners, high interest rates, a lot of supply, apartment demand is definitely not an issue. And he talks about why the demand for renting apartments is so high. First off, we added around 265,000 new renter households in the first part of 2024, which is the highest we've had in several decades.
Yep.
More people moving into the renter pool than before. So he says To claim that apartment demand today is weak because it's less than 2021 is akin to arguing Shaquille O'Neal is short at 7'1" because Yao Ming is at 7'6" is taller. So both of those guys are tall, and even though we had great demand for apartments in 2021, we also had it in 2024. We had really strong demand.
Yeah.
So Shaquille O'Neal and Yao Ming, they're both tall guys. I'm 6'1". What are you?
5'0".
Compared
to these guys,
5'10".
compared to these guys, I'm short, really short.
Yeah, those guys are both tall. Both of those years were really strong, and Shaq was a much better player than Yao Ming.
Yeah, that Jay talks about, and I really like his point, is, there's the cost of buying a home is way higher than normal. The desire, and there's also a desire to rent now. Demand for apartments is still higher than normal. The problem is supply is just way higher than normal.
Yeah, and most of that supply is concentrated in the Sun Belt.
Yeah.
And that's why we are seeing some of those areas where more people are moving. That's also where most of the supply of new apartments were built.
Mm-hmm.
And he says the more than 2/3 of all net new apartment demand over the last year went into the Sun Belt or Mountain West markets. So even though we saw most of the supply of these new apartments were in the Sun Belt, you also have to keep in mind of the top 10 markets for net demand, 8 are in the Sun Belt. And of the top 10 metro areas for population growth last year, 10 are in the Sun Belt.
Yep.
So this is where people are moving. This is where those apartments are needed, and it sometimes will take a little bit of time for the demand to catch up with supply, but that's the area where those apartments need to be.
Mm-hmm.
So Jay's last point when he's answering this question about if the New York Times is right is, yes, there's going to be some challenges with multifamily for 2 reasons. Interest rates have more than doubled in the past 2 years, and supply significantly increased in the last few years. So there's going to be some challenges, but overall, the fundamentals from a long-term perspective over the next several years, multifamily is in a good position, even though there will be some challenges short-term.
Yeah, so I talk to investors every single day, and we do have this new Arizona Multifamily Opportunistic Fund. And some of the questions I'm getting are, what are we seeing in the market? Are these distressed properties coming up right now? Can you shed light on those?
Yeah, so the real opportunity that we've identified for the next 1 to 2 years with multifamily is to try to go purchase some really good assets at a discount. Because the fundamentals behind owning and operating apartments are still really strong, but there are some owners out there who cannot handle these higher interest rates.
Mm-hmm.
They don't have deep pockets, and their loans are resetting to this higher amount, so they have to move off of these properties. So we're going to go acquire some of these assets, and as we talked about earlier, there are assets that are trading, people are buying them, and the market is active. But with higher interest rates, you have to be more selective about what assets you go after.
Okay, so are we seeing any deals right now in the market? Have we passed on any? What's some of the criteria for buying these properties?
Yeah, so we have a real specific box that we are looking for, that all of the items in that box need to be met before we buy an asset. Because just remember, buying an asset is like having a child. It's a great thing and it's an exciting thing, but that ends up being a lot of work, and you need to be committed to that asset. You need to be committed to that child, and you need to be committed to that asset. So the things that we are looking for are, we're looking for initially a big discount, 25 to 30% discount off the market value. So that's our first hurdle. If it meets that hurdle, then we're looking at the operations of the property. We want to see if the units there are a good unit mix. If they're all studios and 1 bedrooms, we don't love that.
Yeah.
We'd rather see some 2 bedrooms, some 2 bathrooms. A better unit mix is preferred. And then we really want to buy assets in locations that are up and coming and are well positioned for the next several years. So we're not buying properties out in tertiary markets. We want to be in these core areas. And you have to remember, you make your money in real estate at the purchase. So that's why we're so disciplined about ensuring that we only buy assets that are at a good price. If we love an asset, but we can't get the price we want, we'll go ahead and wait for the next one.
Can you talk about some of the deals we've passed on?
So we have an active pipeline with our relationship that we have with ABI Multifamily.
Mm-hmm.
They're the largest apartment broker in the Southwest. And the deals that we're looking at are quiet deals. They don't come on the market. They're not on the MLS or LoopNet or some of these areas where typically if you're selling a building, they'll pop up on there.
Yeah.
These are quietly purchased off-market deals, and we're looking at several a week. We have a really strong relationship with the brokers who have relationships with these sellers, and kind of how that works is a seller might say, hey, my broker friend who I bought this building from 10 years ago, 30 years ago, I need to sell this building. I need to move off of it. And most likely in our case, it's over the last few years they bought the building.
Mm-hmm.
And I'll sell it at this amount so that I can just move off of it. In many cases, they're losing some of their equity that they have into it. And that's how these transactions occur. And we have looked at, we were looking at several a week. One example is a building that we really liked in the East Phoenix area, Camelback and 36th Street. It was purchased for about $20 million 2 years ago, and the seller wanted to move off of it. We underwrote it, and we said we would pay about $14 million for it. The seller wanted more around the $16 million range, so we didn't end up moving on that building. But we were close. So we're going to continue to be disciplined, and we think that we're going to be able to find 5 to 10 of these buildings over the next 1 or 2 years. As interest rates stay higher for longer, that window kind of extends, and this will end up being a great opportunity for us.
So when do you expect us to buy our first asset in the fund?
I don't think that's the most important question, because we do have a window that's going to be open for a certain amount of time. We're looking at properties literally every day, every week. But it's more important for us to find the right assets than when we find those right assets. I hope we find something in the next few months that meets our criteria. I think that's very likely. But what drives this is ensuring that it meets everything in our box, because ultimately we want all our investors to have a really good return on this fund. And in order for that to happen, we got to be disciplined about what assets we buy. So we have the capital ready to deploy. We can use that when we find the asset that is right. But it's kind of like you don't want to marry the first person you date. You want to make sure that you found that right opportunity, and we're seeing many suitors right now. So we're going to continue to look at them, and I think we'll be able to find something next few months.
Great. Message there is to go on a lot of dates before you buy.
Yeah, absolutely. It's a long-term commitment.